Imagine, if you will, a chess game. Now replace the chess pieces with bulls and bears, the black and white squares with red and green market indicators, and the players with nations. Sounds peculiar, doesn't it? But this is the game our global economy plays every day. The unpredictable outcomes of geopolitical conflicts echo through the world's stock markets, causing tremors that can turn a bull market into a bear market faster than you can say stockbroker. Take, for instance, the recent tensions between Russia and Ukraine. This conflict had the power to turn the world's stock markets into a battlefield of their own. The bulls, usually the symbol of a thriving market, looked more like deer in headlights. The bears, on the other hand, well, they did what bears do best when they smell fear. They pounced. Similarly, the ongoing Israel-Palestine conflict continues to reverberate through the financial world. With every escalation, the markets hold their breath, waiting to see which way the wind blows. And when it does, it's a mad scramble to adjust sails and navigate the stormy seas of fluctuating stocks. Now let's not forget the role of the United States in all of this. As a global economic powerhouse, the actions and reactions of the US government can often be seen reflected in the stock market trends. Whether it's imposing sanctions or providing aid, every move is watched closely by investors, speculators, and of course our friends the bulls and bears. So, let's dive into the world of bulls and bears and see how they react to the sound of guns and bombs. When nations wage war, it's not just the battlefield that shakes, but also the trading floors. Picture the global financial markets as a serene lake. Now imagine tossing a pebble into it. That pebble is the Russia-Ukraine conflict. Each ripple, each wave, represents a reaction from the stock markets worldwide. The initial splash was when Russia sought to annex Donetsk, Kherson, Luhansk, and Zaporizhia. As the upper house of Russia's legislature approved this move, markets trembled, reacting to the uncertainty. Investors started pulling back, causing a ripple effect that was felt globally. Then came the counter-offensive. Ukrainian forces advanced into the disputed territories. This move stirred up the water even more, causing a surge of volatility in the markets. Stocks, commodities, even currencies, all swayed to the rhythm of this geopolitical dance. As the war machine stuttered, with Colonel General Alexander Zhuravlyov removed as head of the Western Military District, investors held their breath. The markets mirrored this tension, with indices swinging wildly in anticipation of the next move. Western democracies, led by the United States, voiced their strong opposition to the annexation and imposed economic sanctions on Russia. This further roiled the markets as investors grappled with the potential impacts of these sanctions on global trade and economy. So the next time you see stock prices falling, it might not be because of a bad earnings report, but because someone, somewhere, is moving tanks. From the Middle East to the Midwest, no conflict is an island. It's more like a pebble causing ripples in the global economic pond. Let's cast our gaze to the long-standing Israel-Palestine conflict. This hotbed of political tension has, time and again, sent shockwaves through the world's financial markets. During periods of escalated violence, investors often scramble for safety, flocking to traditional safe havens like gold, government bonds, and the Swiss franc. This exodus from riskier assets can lead to significant drops in stock markets worldwide. For instance, during the Muslim holy month of Ramadan and the Jewish holiday of Passover, tensions escalated, resulting in several violent incidents. This turmoil did not go unnoticed by the markets. Investors, ever watchful, responded to the heightened geopolitical risk, and stock markets wobbled. The tech-heavy Nasdaq and the broad-based S&P 500, often seen as the pulse of the global economy, both experienced notable dips. This conflict also has a direct impact on oil prices. Any disturbance in the Middle East, a region rich in oil reserves, can potentially disrupt oil supply, leading to a spike in prices. This, in turn, affects energy stocks and the broader market. But it's not all doom and gloom. Some sectors may actually benefit from these conflicts. Defense and cybersecurity companies, for example, often see a surge in their stock prices as nations ramp up their defense spending amidst rising tensions. In the world of investing, it's crucial to remember that every crisis can be an opportunity. The key is to stay informed and adapt to the changing market landscape. It seems that the bulls and bears do pay attention to the news, especially when it involves rockets and airstrikes. In the great circus of global politics and economics, no one walks the tightrope quite like Uncle Sam. The United States, as a global superpower, has always played a significant role in maintaining the balance between political diplomacy and economic stability. The ongoing conflicts in Ukraine and the Middle East are no exception. The US government has had to delicately navigate these turbulent waters, and their decisions, like ripples in a pond, have echoed through the stock markets. In the face of Russia's aggression towards Ukraine, the US government has taken a firm stance, opposing the annexation process and backing Ukraine's sovereignty. Economic sanctions have been imposed on Russia, resulting in a significant impact on the global economy and stock markets. These measures have not only put pressure on Russia, but also caused a ripple effect, influencing not just the Russian economy, but global markets as well. Meanwhile, tensions continue to escalate in the Middle East between Israel and Palestine. The US government, traditionally a staunch ally of Israel, finds itself in a complex situation as public opinion shifts.